Let's look at consolidated statement of profits or loss and other comprehensive income. The way I'm going to approach this is going to be very quick because I need us to go into the questions for this particular section. Remember, most of the items we looked at in the statement of financial position consolidation will still be relevant here. So there are nothing new that you will see here, but you will just learn how to apply it and we'll start going into questions. So I'm going to break this down quickly into 3 major steps. That's how we're going to approach it. And after then, we'll go into the question itself, right? So anytime you are asked to consolidate profit or loss account, the first step you should do is to prepare a revised financial. So prepare a revised financial statement for parent and subsidiary. So you prepare it separately. Yeah, this has to be separate. Some people call this consolidated or consolidation schedule, but I don't want you to see like that because I don't want it to look any confusing to you. So prepare it, and I will show you how to do that individually, and we're also going to practicalize it using the questions. Once you've done that, you add the income and expenses. That is just simple, right? Which is the consolidation itself. So all of them. And the last step is to split the group profit into NCI portion and parent portion. Right. So now what we want to do is to now explain to you how you do each of these. So this is just the 3 steps. And sometimes let me add for if you have, let's say, OCI, all you need to do is to add the proportion of NCI in OCI to the NCI portion of profits. That's what will give you the total comprehensive income. Let me write it in full. Total comprehensive income for NCI. Yeah. So that's the 4th step. Calculating the total comprehensive income for the NCI, and invariably the balance will be the total comprehensive income for the parents, right? Which is similar to step 3. Just want to put it like that, right? So where the major work is step 1. That's where the major work is, right? And it's important because without step 1, you will not get step 3 correctly. Yeah, so step 1 is very critical, and that's why I'm going to spend some time here on this video, right? So which is, how do you prepare the revised financial statement? Revised FS. That's what we want to look at now. Right, there are major 2 things you need to consider when you are trying to prepare the revised financial statement. 2 things, yeah, that you need to really pay attention to. The first one is when acquisition takes place during the year. So when you have acquisition during the year, remember what you need to do. You need to prepare proportionate values of income and expense, assuming that all those numbers were accrued evenly during the year. Very important. So here, the first thing is to prepare proportionate income and expenses for the subsidiary. Yeah, because excuse me, you cannot acquire a subsidiary half into the year and consolidate the full year income. No. It means that you need to only consolidate 6-month income, 6-month expenses. So that's the first thing you need to check. But if your acquisition is at the beginning of the year, then this one might not be necessary. Yeah. But if it's during the year, it is necessary. The B is the bulk of the work, and that's when you need to make other adjustments. And I will try and list out all the possible adjustments you can always have. Yeah, which is what we'll be saying in these questions we'll be doing. So you need to make adjustment for things like intercompany sales. You need to make adjustment for provision of unrealized profit, goodwill impairment, fair value adjustment on depreciable assets. Here, the adjustment is depreciation, because that would be the additional depreciation or less depreciation, depending on whether it's excess fair value or shortfall, which is very important. Likewise, there might be amortization if you have intangible asset that needs to be recognized at the beginning of the acquisition date, right? So that might also come into play. Likewise, dividend income must be removed from the parent. So if the dividend income is from the subsidiary, that needs to be eliminated as well. We need to take it out. Yeah, there might also be finance income or cost, depending on who is giving the financing. Yeah, so most of these things you see, they are either intercompany transactions or goodwill impairment or fair value valuation that is giving rise to excess or shortfall in depreciation. So this is just like a group of adjustments you will likely face. I don't see that it's going to be beyond this. So if you know how to treat each of these items, you will be very comfortable in this particular one. This is pretty much more straightforward than the statement of financial position. Right? Just follow these steps and it will be quite easy for you. So remember, the first thing is to prepare revised FS, and that's what we're trying to learn how to do now. I would say the first thing is to apportion. So let's say we want to do for subsidiary now. Yeah, you need to do it for both subsidiary and parent. But I'll just show you a typical example for subsidiary, then we'll go into question. Right. So you're going to take for instance, revenue, and you're going to have original number. Yeah. If it's acquisition during the year, then you're going to have time apportion number. So, which means, take for instance, if you have revenue at say 250, and this subsidiary was acquired midway into the year, which means 6 months into the year, then you cannot consolidate 250, you have to consolidate 125, which is half of that revenue, right? So the first thing is time apportionment. When you have done time apportionment, then you now have other adjustment column. So let's assume that for this subsidiary revenue, there are a couple of things. Maybe there's intercompany sales. Then we need to start with adjustment, which will be intercompany sales. So if this particular subsidiary has sold a good after acquisition to the parent, then we need to make adjustment. If it sold that good before acquisition, it is not intercompany transaction because they were not members of the same group at that point. So there is no apportionment, there is no adjustment that needs to be done because that happened before acquisition. But if it happens after the acquisition, then we need to take that sales into consideration. And in that case, all of that sales will be relevant for adjustment. So all the revenue must be removed. So you need to deduct the revenue. So let's say intercompany sales was 50. We are not going to apportion this 50. It's the whole 50 that happened after the acquisition that will have to be taken away. So that will be taken away from the revenue. And in that case, we will now have a revised FS, yeah? So which means the revenue figure for this subsidiary will be 125 minus 50, and that will give us 75. All right, then we'll go into, so that's revenue adjustment done. Then we have cost of sales. Let's say cost of sale is 120 for the whole year, and remember 6 months into the year is that we're assuming that 6 months into the year was acquisition. Yeah, just want to show it before I get into full question. Then it means that we're only going to be dealing with 60 here. Yeah, this revenue that we have taken away from intercompany revenue that we have taken away from that revenue up, we must also take it away from cost of sales. So that's the first rule you are learning. So we need to do other adjustments. So intercompany sales must also be taken away at that same revenue amount. So we're going to take it away. 50, it's gone. You can see it's 50-50. So the impact will be 0. We are taking away from we're taking it away from the sales, and at the same time we're taking it away from cost of sales. Right. So the other things to take away, we'll give some examples of things that might affect our financial statement. So another thing is, so we've dealt with this, you know how to deal with intercompany sales. The same figure, you take it away from revenue and from cost of sales, preferably from the seller's financial statement, please. But make sure you take it from the same financial statement. Don't go and take revenue from the seller and you're taking the same revenue from the cost of sales of a buyer. No, because that might affect your NCI and other computation. Please, that intercompany sales, you must adjust for it on the same company, both from the revenue and cost of sale, the same figure. Please take note. Now, for provision for realized profit, once you calculate your realized profit, the adjustment you need to do is to add to seller's cost of sale. Please take note. That's all you need to do. Just add it to the seller's cost of sales. That's how you treat this, and this is how you treat the other one. Right. Okay. So which means for this one, if take for instance unrealized profit of PUP, let's assume is 5. Yeah, we need to add the cost of sale. Remember, we are assuming that the subsidiary is a seller here, so we need to add it. Yeah, very important. Also, if there was fair value adjustment, if there was fair value, I'm going to come back to goodwill. If there was fair value adjustment, and the fair value adjustment is on a depreciable asset, and this is, take for instance, an increase in fair value. What that means is that if the subsidiary has not taken that into consideration, which is going to be the situation most times in your exam questions, they will tell you that subsidiary has not considered that in the financial statement. What it means is that, remember, in the financial position, we usually add that fair value and we deduct depreciation from it. The impact is also in the financial statement of profit or loss account, and in that case, the excess depreciation must be debited to cost of sales, of the subsidiary. So in that case, we're going to have fair value adjustments, and this is the depreciation part of it. So we need to add that. So let's say that is, take for instance 2, that's going to be added. So we're going to add that. Likewise, if there was intangible asset that was also recognized at acquisition, similar way. So whether depreciation or amortization is the similar treatment. Yeah, especially if it is on production asset, right? So it goes to cost of sales. When we do all those adjustments, then we can have our adjusted cost of sale for this company, and that will be 60. We take away 50, we have 10, then we add 5 and 2, and that gives us 17 as our adjusted cost of sale. Okay, so making progress gradually. So we're done with cost of sale adjustment, and in that case, you've now learned how to make this adjustment. You've learned how to make this adjustment. Now on goodwill impairment, please pay attention to goodwill impairment, because this can either be in the subsidiary financial statement or in the parent financial adjusted statement. And the way you need to do that, usually the goodwill impairment, you can show it separately or you can add it to admin cost. So you can use an adjustment to admin cost, or you can put in a separate line to show it as an adjustment. So what you need to do is, if NCI is measured at fair value, that is the only time you put the impairment of goodwill here. Let's say 10. However, if NCI is not measured at fair value, which means it's measured at proportionate of net asset, then it is going to be in the parent's revised financial statement. And I repeat again, please take note. If NCI is measured at fair value, the impairment of goodwill comes to the subsidiary adjustment. But if NCI is measured at proportionate of net asset, the impairment of goodwill goes to the parent revised financial statement. Please take note. So for this one, assumption is that NCI is measured at fair value, so we're going to put it here. If it has net asset, which means at proportion of net asset, nothing will be done here. This will be 0. That will mean that it's when we are preparing the adjusted P&L for the parent. That is when we're going to have the goodwill impairment. But for this one, we're going to have it here. And I hope that is clear. Okay, so and by the time you do that, you have your goodwill impairment. Or if it's admin cost you are adding it to, you're going to have adjusted admin cost. Likewise, investment income. If the subsidiary has given loan to the parent, we need to deduct that investment income. Whatever it is, it can be one, it can be anything. We need to take it away, right? And if it's in the parent financial statement, if the parent has received dividend from the subsidiary, then likewise we're going to be taking this off, because you cannot receive dividend from yourself. Remember, group financial statement is an entity concept, which means it's a single entity, right? So please take note of that, and I think that explains most of this adjustment. And what I'm going to do next is to solve a full prob question that will show you how all these adjustments are put in place, right? So for step 1, you'll be able to arrive at your adjusted profit, and you will see for this question I'm going to have 75 minus 17. So we're going to have 75 minus 17 minus 10 and minus 1. So we're going to have adjusted profit of 47 for this subsidiary, and in that case you can get the NCI percentage. Let's say if NCI is 15%, then 15% times 47, and that's 7.05. So this will be NCI portion of your group profit when we need it. This is the figure we'll be using, and that's why it's important to pay adjusted P&L like this. Okay, so which means step 1 is done. Step 2 is just to add this schedule we've prepared for both subsidiary and parent. We'll add all the numbers together. That's step 2. And step 3 is now to split the profit into NCI and parent portion. Whatever we have as group profit, if group profit is say 700, it means that we need to take away 7.05 from that, and we'll just say NCI profit is 7.05. Remember, we got that from here. And the parent profit will be the balance, which will be 692.95. And that must always add up to 700 we got at good profit. So that's the mechanism, which is what I want to quickly show you. And you will appreciate it better when we go into questions itself. And that will be in the next video where I'll be looking at a full exam question.